Hello and welcome to this weekly market recap for the week ending November 15th, 2024. I'm Tom Bowley, Chief Market Strategist here at earningsbeats.com, and it's a pleasure to join you once again this weekend. It was quite a week this week. We had a lot. We had a couple inflation reports coming out. They both came in as expected. It was options expiration week, which many times can cause some problems in the market. We saw that as well. I'm going to go into some really key charts that I think you need to pay attention to, things that not only affected this week, but likely could impact next week and the balance of the year. So let's jump in, take a look at what happened last week, and we'll go from there. First, on the major indices, the Dow Jones Transportation Average and the Dow Jones Composite both performed better than the rest of the market. So we had the industrials, the transports, both kind of holding their own, down just slightly. But then as we move to the S&P 500, you can see that the losses were a little bit stronger there. Then the mid caps, the NASDAQ 100, and then finally the small cap index, Russell 2000, which took it on the chin to the tune of 4%. Now, much of this we discussed with our members back on Tuesday when we talked about max pain on the monthly options for November and the fact that it signaled that we could see down movement. In fact, we were nervous enough with that and hourly negative divergences, and I'll be talking about that in just a bit. But we were nervous with both of those, and so back on Tuesday, we did something that was somewhat unprecedented, and we closed out our model and aggressive portfolios about a week before we normally would shut them down. But it was because of the risks that were building in the market short term. So we were not at all surprised by the selling that we saw at the end of last week. It's possible we see a little bit more extending into the beginning of next week. Of course, we'll take a look at that a little bit later. But small caps, which had the most to lose based on max pain calculations that we did last week, did in fact see the worst action last week. If we move on to the sectors, financials actually were the best performing group and finished in positive territory. So that group was able to ignore a lot of the just the basic negative undertones that we saw in the market throughout the week. Three areas, though, that did not escape the selling: healthcare down 5.5%, technology down 3.5%, and then materials down about 3.33%. So definitely a lot of selling in the market, but not so much in the area of financials, and that was good, at least for that area. Moving on to the industry groups, here were the four groups that performed the best last week. So we had the brewers, which is a consumer staple group, jumping 4.8%. Broadcasting and entertainment up 4.6%. This was due in part, probably in strong part, due to the quarterly earnings report out of Walt Disney. Walt Disney beat expectations, had a really nice jump, and led the entire group higher. Airlines remained hot, jumping 4.4% last week, continuing an unbelievable string that we've seen. We'll take a look at that chart in just a bit. And then, of course, banks had another really solid week. Tell you, as long as the 10-year Treasury yield remains, fairly high, and we see these short-term Fed funds rate coming down, this is nirvana for banks. We talked about this all the way back at the beginning of the year, that when the Fed started cutting rates, it was going to be a big boost to the banking group. And that's exactly what we've been seeing. Banks have been on fire now for the past month or two. This is historical seasonality that we see typically in the fourth quarter. I've got a seasonality chart that I'll show you on that in just a little bit. But first, let's take a look at the 10-year Treasury yield. So the 10-year Treasury yield continues to move up, but based on all the intermarket work I'm doing, rates are not going up because of inflation. Areas that would be impacted by higher inflation are not being impacted. So it's telling me that this rise in the 10-year Treasury yield has much more to do with what the market believes is coming in terms of our economic growth, not what's coming in terms of inflation. So, and I'll show you a couple of these, a couple of charts that kind of fit in with this theme, but I really am bullish. I don't want 10-year Treasury yield going up too high, but the fact that it's going up while we've got the short-term Fed funds rate coming down, that is nirvana for banks, especially the small and mid-sized banks. Let's keep moving, though. We got a lot to go over in this session. Transports. So transports were the best last week of the 6 major indices that I showed you. We were up, setting new highs throughout much of the week. We did have a little bit of weakness on Friday, but other than that, we've continued to trade very, very strongly. We made this breakout of this sideways consolidation, pattern that we had been in for many, many months, all the way throughout 2024, even back into 2023. Finally made that breakout, and I think it's the start of a much bigger move to the upside in transport. So I would certainly keep an eye on this group. Small caps. So small caps, here was the pullback. So Monday, they look strong. It was Tuesday morning that I started growing much, much more nervous about the small caps and about the market in general, because on this latest push to the upside on Monday, we had negative hourly divergences form. Let me show you what I'm talking about here. So here's the IWM, and you can see the price action. This is an hourly chart for 1 month. So we're just going back the last 7 or 8 days here. But you can see the price action going higher. And look at the PPO rolling over and printing lower highs on the PPO while price action goes up. That's generally a sign of slowing momentum. And I typically look for at least 1 to 3 days of selling. In this case, we rolled over on Tuesday and really saw the selling throughout the week. So it's been 4 days and still counting. And I need to point out that the Monday following option expiration Friday, monthly option expiration Friday, the Monday following, historically since 1950, the worst day of the calendar month. Every calendar month, the Monday after monthly options expire. So that's coming up this Monday. Historically, 63% of those Mondays go down. Only 37% of those Mondays go up. So it's not a slam dunk. It's not a guarantee, but a pretty strong tendency. And the way we finish this week, I wouldn't be surprised to see us down a little bit open next week. We'll have to wait and kind of see there. But this is the IWM. Let me show you the S&P 500. So look at the S&P 500 going into Tuesday, or actually into Monday. You can kind of see prices still going higher, but look at what the PPO started doing, rolling over. We went back up one more time. This was on Wednesday, and yet the PPO was showing no strength whatsoever. And then we saw more and more selling throughout the balance of the week. If I pull up the NASDAQ 100, very similar action on the hourly PPO. Prices going up. We set the high at the beginning of the day on Monday. That was when we saw PPO already starting to roll over. Like the S&P, we tried a couple more times to go up. There was no movement to the upside in that hourly PPO, and then the selling finally kicked in. So we'll see, where a bottom might come in. But just looking at the NDX, the NASDAQ 100, I'd be looking at this gap support down here, which looks to be somewhere around 20,240, which would probably be another, I don't know, maybe 0.8% down from where we closed Friday. But if we can't hold that, we would probably have to pull up maybe a longer term hourly chart. If we go back maybe 3 months, you can see some other lows that came in between maybe 19.7 and 20,000. So this whole area right here would be kind of a support area if we don't hold that 20,240 area and we end up trading back down below 20,200. That would be the next area I'd be looking at. But we're kind of sitting on a trend line. If you connect the low from early September and then again from right at the end of October, early November till now, this trend line where we finished today is almost right on that trend line. So we've got some mixed signals as far as whether or not we're at a bottom in the near term. But I think if we do go lower beginning of next week, I would say by the middle part of the week, I think we're going to be set up for a pretty big move back to the upside. So I actually, I got out of a lot of positions back earlier in the week, started getting back in, got in a little bit yesterday, Thursday, but ended up getting back into quite a bit on Friday. Just because, IWM's down 4% this week, over 4%. So it just made sense, in my opinion, because I think the group's going a lot higher to be back in. I mean, if it turns out that it goes down 6, 7, 8%, so be it. I feel like I've already kind of I'm kind of a little bit ahead of the curve, having gotten out near the top and then jumping back in after some selling, like we had discussed with our members back on Tuesday at our Max Pain event. Moving on. So the Brewers very, very strong over this past week, but this is a group that tends to move and then just kind of, I don't know, kind of peter out a little bit. Let me go back and let's see if we can pull up a little bit longer chart. I mean, it's a defensive group. It's not going to trade like technology. It's not like semiconductors. So here you can see the group took a big drop back in 2021. And even after this huge move, it is currently sitting back just slightly above where we were at the end of 2021. So while the market's been taking off and we've gone to all-time highs, this group's just been languishing. So it's really hard to get excited about a week when we go up, especially when we see key overhead resistance not that far away. So yes, Brewers did well this week. We had the, we had some selling. We had a little bit of money rotating toward more value, more defensive types of groups, and as a result, more dividend-oriented groups. And as a result, we did see some buying in this group. I don't know that it lasts. I certainly wouldn't trust it. Broadcasting entertainment's a different story, though. We did get a nice breakout here. This is a group that can run from time to time. We need Disney to perform well. Disney had a great week after earnings. I suspect that's going to continue with maybe some pullbacks along the way. So I like this group. I think this is another area within consumer discretionary that could make a pretty significant run. Here is the Disney chart. So here was the gap up. Kind of failed. I mean, we gapped up, went all the way to 115 on Thursday and came back down, closed at the low around 109. But then we came right back on Friday, gapped up, and then took off and actually closed above the high from Thursday. Volume was very strong on this move to the upside. We do have overhead resistance on Disney from all the way back at the beginning of April of 2024, and that's about 122.50. So I see maybe another $7.5, and then I think you have to respect that resistance up there. Airlines. I mean, we haven't even had a 20-day test on airlines for the past 3 months. I mean, it has been straight up. The 20-day is going straight up with it, and so is the 50. Great configuration. I can tell you that, like the Brewers, this is another group that takes off, no pun intended, but it can be a little bit of a rough landing, if you know what I mean. So let's pull up a chart. Let's go back. I'm going to do a weekly 5-year chart because you can see back in 2021, we had a really big move, and then it was not very good. And then we had this rally over about 6 weeks. I mean, here we went from a low of 140 to a high of 210. That's a 50% move in a month and a half, and then right back down. Look at what we did back in 2023. I mean, we had a really big move off the low 135 up to 200. Again, 50% move in about 4 months. And then look at what happened. Right back down to new lows. And so we've seen rallies, we've seen failures. This rally definitely has taken out some key resistance levels. So I like that. And if you look at this, I mean, every single week, just continuing to go higher. And I think you have to ask yourself a question. Why would airlines be going up at this rate? What could possibly suggest that airlines should be going up this fast? I would argue a strengthening the economy down the road, which is exactly what I talked about earlier, that with the 10-year treasury yield. I think it's that the yield can go up for a couple of different reasons. Folks sell bonds for different reasons. One is inflation, but another is when the economy strengthens. Because why do you want to be in bonds yielding 4 or 4.5% when if the economy strengthens, S&P 500 profits are going to shoot through the roof, multiples are going to expand, and you're going to want to be in the stock market because it's going to make a lot more money for you than the bond market in an expanding economy. So this is telling me the airline is this move that we've been seeing over the last couple of months, telling me market's anticipating more strength ahead. Banks. So this is the key with banks. Banks, especially small and mid-sized banks, were really suffering when rates were going higher, and especially when they remained higher. And I'm talking about the short-term rates, the Fed funds rate. When that was going up and it actually went above the 10-year treasury yield, that is what results in an inverted yield curve. And an inverted yield curve, essentially, I'm a former practicing CPA. I audited small banks. So I do have, some background to, give you a little bit of insight here. But banks use the Fed funds rate is what they use to borrow. So banks are borrowing at higher rates when the Fed funds rate is up. When the Fed starts cutting rates, I'm not talking about the 10-year Treasury yield. I'm talking about when the Fed starts cutting the Fed funds rates, funds become cheaper for small and mid-sized banks. Large banks, most of them don't need the Fed. Most of them are cash cows and they're fine. But a lot of the smaller banks do. If they don't have enough deposits, and they've got other activities in their bank and they need to fund it, they're going to have to borrow. And so a lot of times they'll borrow at the Fed. If the Fed funds rate comes down, their borrowing costs get cheaper. And at the same time, if the economy is getting stronger, the 10-year Treasury yield stays up. We don't want it to go too high. Don't get me wrong. I kind of like up to about 5%. Over between 5 and 6, I think, is really a gray area that I'd rather not go into. Above 6, I think, would be horrible for stocks. So we don't want to go there. But I think if we stay in the 4.5 to 5% range, I think we're fine, especially with those short-term rates coming down, because now the net interest margin is expanding on the banks. What does that mean? More profits. Well, if they get more profits and the economy strengthening, loan losses go down, more profits. And then they also will be willing to lend. And what have many of the small caps and mid cap companies lagged over the past few years? The ability to borrow. So all of this ties into the small caps. And we're going to be talking about that a lot more tomorrow. And I'll talk about how you can join us in just a few minutes. But anyway, banks doing extremely well, going up even with the market selling off. I'm not shocked. Here are the banks. I went back 12 years to show you the seasonality in the fourth quarter. I've talked about this plenty. I just wanted to remind you. In the fourth quarter, over the last 12 years, banks average going up, and I'm just talking about the bank index. It averages going up 11.1% per year just in the fourth quarter. 11.1. Now, I can go back and I can add up the rest of these months, the other 9 months. Let me add them up for you. 0, 3, 1, 5. That's going to be minus 2, minus 0.6, plus 0.3, even, plus 3.6, plus 2.4, plus 1.1. So the other 9 months combined, banks have averaged going up 1.1% over the last 12 years. Fourth quarter, they average going up 11.1%. When do you think it's a good time to be in banks? It's the middle part of November. I mean, look at how often the banks go up and look at their average returns. Most of their strength comes in October and November, but they still show strength in December as well. So I think we're getting this big move that we typically get. And then we've got the fundamental news to boot, with Fed funds rate coming down and the 10-year Treasury yield going up because of a strengthening economy or an expected strengthening economy. Really, I mean, I said it was going to be nirvana for the banks and for small caps, and that's exactly what we've been seeing really over the past few months, maybe even up to about 5 months or so on the small caps, 4 months. Anyway, volatility. So volatility, once the election was over, volatility tumbled. When the volatility is low, stock market normally goes higher. We did pull back here. I think it's options related. I think it could have been related to those negative divergences I showed you. When that was pulling back, the VIX went up, failed at that 20-day moving average, came back down. I think we could still see a little bit of a pop in the VIX next week, maybe beginning of the week if the market is weak, if the S&P 500 is weak. But otherwise, I see the VIX remaining low going forward as the stock market climbs. The dollar. Okay, here's another reason that I don't believe inflation is a problem. We're kind of trained over the last few years that 10-year Treasury yield goes up because investors want to make sure that their returns are sufficient enough to cover inflation. So, and that's one reason why yields go up. You sell bonds. Who wants to hold a 3% bond if inflation goes to 6%, right? I mean, that's just losing money. So if inflation expectations are rising, normally folks are going to sell bonds so that the yields move higher. And it's got to get to a point where the yields are high enough before you're going to get buyers coming in for bonds. Now, the dollar, there's hardly anything out there worse for the dollar than inflation. It eats away at your currency. Look at the dollar over the last month and a half, and you tell me if folks are worried about inflation. I mean, I don't care about CNBC and what they talk about. I'm talking about where the money's going. Money is pouring into the dollar. Who would be buying the dollar if the US had an inflation problem, or if we were going to resume the inflation problem that we had? Nobody. You've got to learn to read the markets, the intermarket relationships. The dollar's going up, the 10-year treasury yield's going up, the VIX is going down. And what does all this mean? It means get out of gold. Look at gold since the beginning of this month. The dollar's taking off, gold's going down. The volatility index is coming down, gold's going down. Gold loves a weak dollar. Gold loves volatility. It loves fear in the market. It's a hedge. So when you don't have the VIX going up and you don't have the dollar going down, there's really no reason to be jumping into gold. In fact, we lost $250 an ounce on gold over the past 2 to 3 weeks. That's almost 10% in the last 2 to 3 weeks because of the changing economic conditions. I mean, you can stick with gold if you want. I've said before that gold from an absolute standpoint may go higher. And as long as it was going higher, you could stick with it. But I said, keep your stops tight, because when VIX comes back down and when the dollar goes up, and I was expecting both of those, when that happens, the history is not good for gold. All right, XLY. I didn't talk about discretionary earlier, but it actually did perform pretty well this week on a relative basis. And I just want you to know that discretionary broke out on an absolute basis. The other thing I want you to know is that consumer discretionary relative to consumer staples throughout this entire bull market has been in an uptrend. We go through periods of weakness. 2022, cyclical bear market, yes, we went down some, but we have rallied back, and now we just recently broke out on a relative basis, discretionary versus staples. Why does this matter? Well, there are hardly any intermarket ratios that are more positively correlated to the S&P 500 than the XLY XLP ratio. In other words, when this ratio is going up, it is a great sign that investors are willing to be more risk on. They want risk. They'll take on risk. Taking on risk is what sends secular bull markets higher. So we are breaking out on this, on this XLY XLP ratio to about almost a 3-year high. And so the only thing we need to do is now climb up above that late 2021 high that tipped us off when it started to roll over late in 2021, even though the market went to a new high in 2022. Remember that? This ratio started going down while S&P was going up. That was not a good sign. And we ended up, that was one of the things I think that led to the cyclical bear market in 2022. But we got things going the other way now. Now we're getting a breakout, which I think is really bullish and is going to carry S&P 500 prices higher. All right, before we go any further, I wanted to let everybody know that if you go over to earningsbeats.com, both words are plural, earningsbeats.com, you will see on our homepage a place where you can click to register for our small cap and mid cap webinar that we're having on Saturday, November 16th. It'll be at 11 a.m. Eastern. If you see this video after that time, no problems. You can still register and get the recording, and I would highly encourage you to do so if you don't see this video, or if you just can't make it on Saturday. I know folks do a lot of things on the weekends, but we are recording it and making it available to anyone who records, or to anyone who registers. If you're already a member at Earnings Beats, you don't need to register. We will automatically send you room instructions before the 11 a.m. event starts. So you're fine. You're automatically registered. We'll do the same thing with those who are on the EB Digest. But for folks that are new to us, absolutely, you want to make sure you register. Actually, I think the EB Digest folks are registering for this event as well. So if you are just on our EB Digest, which is our free newsletter, I think you should go in and register just to be safe. But yeah, if you're new to Earnings Beats, you really should. If you like what we talk about and how we look under the surface of the market, you're going to love this webinar tomorrow. So make sure, and we're going to be talking about the rotation that's taken place and how that's going to impact trading going forward. I'm not just going to tell you what's been happening for the last 6-8 weeks. I'm going to be telling you what's going to happen or what I think is going to happen, and I think you need to be there. So again, go over to earningsbeats.com, check that out. If you are on a mobile device, we're putting a slide up right now. That is this is an opportunity for you to scan the QR code, and your mobile device, you'll be taken right over to our landing page. You can sign up there. Trying to make it as easy as we can for everybody to sign up, become part of our Earnings Beats community. I think it will help you in the long run. We've been doing this for a long time. We've been in business for over 20 years. We've had members who have been with us all 20 years. So anyway, make sure you check that out. We do this because we want to give back to the community. Okay, a couple other groups I want to look at. Semiconductors. So semiconductors have been weak. You can see the last 6 trading days. We got right up to the 21,000 level that we printed as a high back in June of 2024. Couldn't get through. Now we're rolling back over again. It did not help that on Thursday evening, Applied Materials reported they beat top and bottom line, but the market reaction was very negative, and that helped to create some additional selling in that group. Also, NVIDIA, which I'll show you a chart in a second, NVIDIA had a ton of in-the-money call premium. Had a feeling we were going to see a pullback. It has started to pull back. It's saving market makers a lot of money. And so I wouldn't be surprised maybe at the early part of next week see a little bit more weakness there as well. But I'll look at that chart in just a second. Next up, software. I just recently talked about software making a huge breakout in terms of absolute price action. It also, on a relative basis versus the S&P, moved up to about a 4-month high this past week. A lot of it, I think, was due to options. A lot of software stocks trade heavily in the options world. So there were a lot of in-the-money calls. I suspect that we're going to have a pretty nice opportunity in software at some point early next week. So keep that in mind. And then let me give you these 3 Mag 7 stocks that I think are worth watching. NVIDIA holds back, hits the 20-day moving average. Might just look like a normal 20-day moving average, but somewhat of a coincidence that it happens during option expiration week when there's a ton of in-the-money call premium at stake. Also, Tesla, same deal. On Monday, it was up to, 350 on the close, got up to 360 intraday. Max Pain week, option expiration week, 4 days later, we hit a low of 309. We were down $51 from the high, which is about 17%. In 4 days. You tell me there's not any manipulation with market makers around this time of the month? You be the judge. How about Amazon? Amazon making a huge breakout. Let's look at this long-term weekly, 5-year weekly chart. Look at the tops here, 190. We went up to 200, had a quick move down late July, early August, and now we've rallied back and we've broken out again. This is an all-time high. I can pull up the monthly 15-year chart. Amazon is now in all-time blue sky territory. And I like the stock. I think it's going to have a very strong period ahead. We're pulling back right now, option expiration, testing some key support, but I see Amazon going a lot higher. All right, that is it for me. Went through a lot of information, tried to get through it as fast as I could. But again, please join us tomorrow morning. We'd love to have you. And again, if you can't make it because you have other plans or because you're seeing this video too late, still go to the page and register because we'll send you the recording. So you can look at it at your leisure. I'll try to keep this session to no more than about 45 minutes to an hour tops. If I can get through it quicker, I will. But you'll want to check this out. I think it'll help in your trading ahead. Anyhow, listen, everybody have a great weekend ahead. Be careful beginning part of next week as we once again have to deal a little bit with options expiration. But from there, I think things will start to pick back up again. Have a great weekend, everybody. Happy trading.